Summer is not over yet and winter is coming. What can you do if you expect a recession? Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy Blog podcast, where I and my co-host Veronique will help you invest with more conviction so you can enjoy your retirement. Dividend growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. It's been a while for us, even though we kept running those episodes because we pre-recorded a bunch of them. So I kind of feel like that we're doing this live. So I'm all excited. It's been more than a month, actually. We haven't recorded a podcast, Vero. How do you
Right.
feel about that?
Honestly, this morning I was like, oh my God, it's been such a long time. Like, I did my hair and everything. Like, I was like, I need to be ready. And,
I did
anyways,
mine too.
I think it's gonna be a good episode. I think we're like full of energy this morning, right?
Yeah, definitely. I did the same thing with the Moose on the Loose, my small podcast, and I started to record a few days ago, like kind of like more close to the date of like publishing, and it felt just good to kind of come back. So even though we're still in summer mode, kids are about to start school, but they're still home.
Right.
So you have that feeling that we're still in summer, but I don't know. I'm eyeing September right now, and I feel that we're ready to grind a little bit more. So it's gonna be fun.
Right. So, Mike, you've been warning investors about an upcoming recession for years now, but it hasn't happened yet. So, you still believe it's around the corner. So, today we'll look at like the signs that support your view and discuss how we should get prepared.
Yeah, that became a running joke because I started to talk about this in 2022. So I'm pretty much like 3 years late at this point. So if it happens in the coming months, I'm not gonna say I told you so because that would be just completely ridiculous. And I'm not a person of like I'm not the type of person that is like a fear mongerer, and I'm not trying to,
Mhm.
to scare you today, but more to give you a little bit more of a perspective on which kind of economic data that you should be following, which kind of metrics, and what you should be doing with your portfolio, regardless of what's going to happen this fall. And ironically, since 2022, I did not change a single thing in my strategy. I have the same portfolio, minor tweaks here and there, but I would have made them anyway. So we'll see also why, even though I believe that the recession is just around the corner, why I have done not anything different with my portfolio.
Right. So, first, it's important to make a difference between a market crash and a recession. We've experienced a couple of minor market crashes in recent years, but the last official recession dates back to 2008. How would you describe the two?
Yeah, so I thought it would be a good idea to start with some definition because, like, the market crashes, as you mentioned, are just spelled right, left, and center. I mean,
Hmm.
for some people, we had the market crash this year, like on Liberation Day in April. I mean, that was not a like that was nothing. That was like business as usual. That was like just another Tuesday. Yet you go in the media, you go in social media, and then people are talking about depression, stagflation, market crashes, and then you look at the market, it's just like, dude, we're up. So what are you talking about? So I thought of like clearing some of those terms today to make sure that we're all on the same page. So the first thing is, by definition, a recession is two consecutive quarter where the economy is negative. So the economic growth, the GDP, is negative. So technically, we got that in 2020. So that's why we're saying, yeah, we really
Hmm.
had a really good recession in 2008. But if you're looking for two consecutive quarter where the GDP is negative, well, you're going to find that here and there, but it's not necessarily a major recession. But I mean, at one point we have to agree on what are the terms, right?
Right.
Same thing with the market correction, the bear market, and a crash or a crisis. So, for a market correction, what I use that term is when the market is down 10% from its peak. So a 10% drop is any other Tuesday. It happens all the time. If you look at it like at the either the TSX 60 or the S&P 500, and you look at each time the market went down by 10% from a high point, you could have like three times in a year, and it's not going
Hmm.
to be even surprising. So those are market fluctuations that a lot of people are scared of, but if you stop watching your portfolio fluctuate daily, you're not going to notice them, but they happen all the time. Then you have something bigger, which is the bear market. A bear market is when from the peak value, it drops by at least 20%. And those are a little bit like they don't come that often, but still, we had one in 2022 when
Hmm.
the interest rate started rising. We had another one very, very quickly in 2020, which dropped and then went back on. And actually, if you look at the numbers back then, you could have called this a depression, but a depression that lasted literally like 6 weeks. So not too sure if you can call that a Great Depression or not. And then another one that we had was in 2018, from roughly the summer of 2018 till Boxing Day on December 26th. When you look at something bigger, like a real crisis, a market crash, something that lasted more than a flash in the pan, like more than like
Hmm.
18 months or 2 years, well, then we had one in 2008 with the financial crisis, where the stock market took about 4 years to fully recover, depending on how you were invested. And another one happened in 2000 with the tech bubble. So when we have a recession, is economic data that is slowing down. So you have like people that are buying less stuff, so therefore companies show fewer sales, and then you have fewer jobs because they're not going to hire anymore. And therefore, if you have fewer jobs, you have like consumers spending even less because
Hmm.
they're afraid to lose their job or they lost their job, and so on. So it's kind of like a vicious cycle. And most of the time, you will have a bear market that will come with a recession or at least a market correction. The difference here is when you look at economic data, you look backwards. So when we're going to say, oh, we are officially in a recession, well, technically, it's been 6 months that the economy is slowing
Hmm.
down. So it's been a while. We're kind of late on the news, like the official news. On the other side, when you look at the stock market, it goes the other way around because the market is looking forward. So it looks at the situation right now and then try to price what's going to happen for each company in the future, in the usually in the next 12 months. I rather look at the next 12 years or more, but when you look at the stock market, it's a little bit more narrow on the next 12 months, but yet it's still possible that you have very bad economic data, which we had, for example, in 2009, but the stock market was already on its recovery path from the crisis of 2008. So there is always a small disconnection between those two.
Right. Now, there are multiple ways to identify that a recession is coming. One is an inverted yield curve. Can you explain what that means? And is it something that we currently observe?
Yeah, that is something that if you can pull out at a party, you're gonna sound like a genius. You're just like, yeah, I'm a math nerd. I know what an inverted yield curve is. Actually, it's quite simple. The yield curve is based on government bonds. So you have like T-bills that are like very short term. Then you have like 1 year, 2 years, 3 years, 5 years, 10 years, and so on. So the
Mhm.
yield curves that we're looking usually is the 10-year bond versus a shorter term, so like 1 year or 2 years. So usually what you're going to see is you're going to have a lower yield for a shorter period, which kind of makes sense because if you
Right.
secure your money for the long term, you don't know what's going to happen in the next 10 years. So you kind of get a bonus for that. When the yield curve is inverted, that means the 10-year bond will offer a lower yield than the short term. And that happens when investors are more interested to secure their money short term and not long term because they don't believe what's going to happen in the future. Right
Mhm.
now, what we look in the US and in Canada, we have a positive yield curve. There's not a big spread though. There's not a big difference between the 10-year and the 2 year, for example, but it's still positive. So as of August, mid August, we had like a difference of like 0.58%, which means the 10-year bond offered a 0.58% yield more than the 2 year. Same thing in Canada, where actually the difference is like 0.72. So everything looks normal right now. It's close to be flat on the US side, but for the Canadian yield curve, it looks pretty good, which is quite surprising considering all the bad news and all the fear and all the
Right.
concern that we have around the economy right now.
And Mike, we're also seeing some layoffs, especially in like particular sectors, and a softening job market. In your view, how important is employment data when assessing recession risk?
Well, that is probably even more important than the yield curve. I mean, the yield curve tends to, when you see an inverted one, it has a pretty good chance to forecast a recession, but it's not 100% shot. And of course, all the metrics we're going to talk about today, it's more like when you analyze a stock, well, you cannot take a buy or sell decision just based
Hmm.
on one metric. You cannot say, "Oh, I'm going to buy this company because it has a PE ratio of 12." Well, you
Right.
need a little bit more information than that to trade. So to see what's going to come up with the economy is a bit the same thing. However, when people lose their job, that makes a big difference in the economy. As I
Hmm.
said, they're going to spend less. Then companies, it's going to reflect on their sales, on their earnings. They may lay off more people, and so on. So we go into that cycle. One thing that is happening right now that is quite interesting is the numbers from the Bureau of Labor Statistics on the U.S. side were revised and they were not good towards the beginning of August. And then Trump didn't like that, of course. I mean, as a president, you always want to show your people that you're creating job, not the opposite. And over the past few months, like he was able to write that song and say, well, see, the economy is going well, we have jobs, everything is fine. And then the Bureau of Labor Statistics just said, yeah, well, because the way it works is that they survey companies. It's not like they call like the 400 million Americans to say, do you have a
Hmm.
job? Are you looking for one? It's not the way it works, right? They do surveys, and depending on how many people they get answer and how much data they can get, then they try to extrapolate and give us like the real numbers. So sometimes you have to go through recalculation, and in this case that was not positive for his presidency, so he just fired a guy who actually the woman who was in charge of the labor statistics bureau.
Of
It's kind of
course.
interesting. Yeah, of course. So we're gonna see how magically the numbers are. I mean, because technically you cannot really play around those numbers. I mean, if they're good, they're good. If they're bad, they're bad. But I mean, it's
Hmm.
just the way it is, right? You go outside. If it rains, you might want to fire the person at the video, but it's not going to change how it looks. It's still going to rain. So we'll see in the coming months if the numbers are changing magically and that person was completely incompetent, or if it was just the real numbers and then we don't have something very strong. So the US unemployment rate right now hovering around 4%, still pretty solid. In Canada, we are slightly going up around like close to 7%, depending on the month. We're slightly below 7% right now, but that has been going on for a few quarters already.
Hmm.
So, of course, we have a lot of concern, but so far it's relatively stable. Keep in mind, there is a lagging impact on all the tariffs news. Like, first, the tariffs were announced and changed and announce and change and announce and change. And there was like that. It's still to this date, it's still not 100% completely clear yet
Right.
which countries are going to pay how much on which type of goods. And it's probably going to be an ongoing story for a while. So because of that, and it's kind of like ironic because Canada did not sign a deal with the US, but latest research from RBC claimed that over 90% of goods are still under the Trading Act, so tariff free. So while we're all panicking because specific industries and specific goods are getting tariffs, it's less than 10% of everything that is being sold right now in the
Mm.
US. So how it's going to play out in the future, like the story is not done yet.
Right.
We're still in the fog at this point. And this is usually the one of the biggest problem with economic data is they are always behind, like I said before. So right now, you also saw that a lot of companies boosted their inventory to not get caught in that kind of problem, like short term, just to give them a little bit more time. So the same way the tariffs has been changing from April to August many times. Well, that was also to give countries, but also companies, some room to like reinvent themselves and revise their business model and so on. But some of them just said, well, you know what? If we buy in bulk right now, we're going to buy a few more months. So it's just going to
Hmm.
be easier to try to find solutions, try to adjust their cost and see how it's going to happen. But eventually, companies are going to slow down those purchases, and then we're going to have the real impact of tariff. Maybe it's going to happen just in 6 months from now, actually. But it's
Mm,
just to keep that in mind, because right now you look at the situation, so far so good.
right.
It's kind of ironic because I expected that it would be a lot faster to get
Mm-hmm.
worse, but right now I can say we're not close to a recession at this point.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. Okay, so now consumer spending drives a huge chunk of the economy. What are the warning signs that people are pulling back? And is this what we're seeing right now?
So one thing I love to do, and the market is like very wary of that, and they spend a lot of attention, are earnings calls,
Mm-hmm.
especially in the consumer discretionary and consumer staple companies. Even more in discretionary, but like for example, when we had like the interest rate rising in 22 and 23, if you were listening to the earnings calls for Home Depot, for example, they were saying, yes, our sales are still good, but now consumers are going to do very small projects, just like
Mm-hmm.
painting or just like doing a patio. But a few years before, right after, like right in the middle of COVID, they were just like, okay, well, let's change the kitchen, the bathroom, and complete the basement, all that in a single year. So, of course, you have a good indicator of what's going on in the economy when the consumer says, yeah, well, this year the big project will be to paint just the living room. So, of course, not exactly the same budget, not exactly the same impact for Home Depot. That kind of like phenomenon has a lot of repercussion on a lot of companies. So by listening to earnings calls, to look at same store sales, those are metrics that will give you a lot of information. Sometimes you will have also like average ticket per sales, that is super interesting in the retail to see if consumers are spending more or less, because sometimes you're going to have like the same traffic, but people are just like going for like small errands, and then the ticket per sale is slowing down. Another indicator that is interesting to follow is the US consumer sentiment. Again, based on survey, but it gives you a pretty good idea just to show you how it fluctuated. It was around 80 back at the beginning of 2024. So January, February, very strong consumer sentiment. Now it's down to 58. So you can see the
Mhm.
fluctuation here. So 100 being like everyone is like jumping on unicorns and super happy about the lab about life. You're never going to see that. But when you see the trend going down, and that started at the beginning of January 2025, it went down very fast. Then overall, all the news around the tariffs, they kind of like smoother in. It was
Mm.
not as catastrophic as expected. So it went back up slightly, but we're still a lot lower than we had at the beginning of 2024. So what does that mean? It means that if consumers are not that positive toward the economy, chances are they will likely increase their saving rate or try to pay down their debt instead of buying a new truck, go to Disney World, and renovate their house altogether. They're going to slow
Mhm.
down in their expenses. So if they tighten their budget, well, then you go full circle. You're going to have like more earnings calls where your CEOs are saying that they're selling less stuff and the retail is struggling a little bit more. So
Mhm.
still, we're not in catastrophe territory yet, but the upcoming quarters are going to be very interesting to follow because we already have signed many industries, many CEOs are saying that they see a slowdown right now in their
Mhm.
sales.
And what about the housing market? Like, it seems like it has cooled down in many regions. So, should investors see this as a red flag, or is it just a return to more sustainable levels?
Well, again, I was kind of surprised when I pull out the housing starts for both Canada and the US because they are stagnant and
Mm,
weakening, but they're not going down like there's no tomorrow. Still, they're not
right.
strong. Like that is one thing that is for sure. And then you can ask yourself, maybe some housing starts have been boosted by the fact that if you start your house right now, you have your submission, you know how much you're going to pay, and you're going to avoid any tariffs on lumber that could be coming in the coming quarters. So once again, we have a metric that right now is not strong, a little bit more on the weaker side. In 2025, we see that depending on the month, we have a little bit more housing starts than before, but that is probably also being pushed by tariffs. So next year, we're going to have a clear picture. I expect that it's going to continue to be at best stagnant, maybe slowing down a little bit more.
Okay, so at Dividend Stocks Rock, we follow quarterly earnings for over 1,000 companies. Corporate earnings are slowing for many of them. Is this a sign of an upcoming recession and potential dividend cuts?
So, this is where it gets really interesting about the stock market. As you saw, the overall stock market on both the US side and the Canadian side is up roughly double digits since the beginning of the year.
Hmm.
So, a lot of fluctuation, but investors are not that concerned. I mean, keep in mind, 23 was an amazing year. 24 was an amazing year, and we're still on to have another double digit growth for this year. It's kind of crazy. And of course, there
Right.
are a lot of things that could happen between September and December. So don't quote me on
Sure.
that. Maybe we're going to do an episode like before Christmas and then we're going to be down 5%. Everything is possible. But in August, we're still in the green big time, which is quite surprising. So it's really a case by case scenario. And even then, sometimes the market expected worse numbers over the past
Hmm.
6 months and they got better than expected, even though they were slowing down. So that's another thing that you have to keep in mind. For example, if most investors and financial analysts expect a company to show a revenue drop of like 12% this year based on tariffs or whatever economic situation, but the company reports revenue down 8% and they were able to make a lot of effort in cost reduction, so the earnings are flat. Well, that would come as a good news because you
Hmm.
expected minus 12, you got minus 8, and you got flat earnings. So then you're just like, oh, that was a good quarter. I mean, depending on which side, right? If you want to be
Right.
positive, it's a good quarter. But if you're really looking at numbers, it's not that great. I mean, if your boss is telling you, yeah, I mean, you're not going to get a raise today, but you're keeping your job. Yes, okay. So it's a good news because you still have your your paycheck, but your paycheck is not increasing. So it's not
Hmm.
exactly a good news. So it depends on which side. So some companies, some sectors have reported very strong revenue and earnings. Technology, for example, that has been just crazy. The hype for AI and the growth there is definitely not slowing down. On the consumer discretionary though side, it's completely different. That has been a little bit tougher. And as expected, I think the next quarter are going to be rough as well. The industrial sector is hard to tell because you have a lot of pre-orders. And as I explained before, and even sometimes in retail or in other sectors, you're going to have consumers doing the same thing. So not only companies are boosting their inventory, but for example, Apple reported like a strong quarter for iPhone sales, not because they reinvented the wheel, but just because a lot of consumers probably thought, yeah, I'm about to change my iPhone in the next 12 months, but maybe
Hmm.
next year it's going to cost me 2500 instead of like 1500. So I'm going to buy it right now. And that's again more about the fear of tariffs. And I'm not necessarily expecting Apple to report double digit growth sales for the coming quarters for their iPhone, but that's what happened. That was just happened. If you look at
Hmm.
railroad and trucking, which is all related to transportation goods, then everything is slowing down. So you have definitely a strong narrative in the background where a lot of industries are not necessarily in panic mode or catastrophic mode, but they are slowing down. They are
Hmm.
cautious about their investment, about their inventory, about like their upcoming projects. So you have a lot of signs across the earnings that many companies are not having the best year of their life.
Okay, so markets have been choppy and nervous this year, like you've said, bringing lots of volatility for investors. Is this also a sign of an upcoming recession or not so much?
Well, you're going to have like a lot of bad headlines. You're going to have a lot of talk about that. Like I said in the introduction, too many people on social media call that for a crash and stuff like that. I'm like, dude, it's just like 10% down. It's just
Hmm.
nothing. Like
Right.
literally, if you were on vacation in April and you just came back in May, you didn't even know it was going on.
You're
So
probably
don't
up.
yeah, seriously, you're probably up. So don't start telling me that like it's Trump economics and then he's going to kill the country. And I'm like, Just calm down a little bit. So, a lot of volatility, yes, but in the end, the portfolio, the market is doing very, very well. So, it's actually not meaning anything. It's just market
Mm-hmm.
noise. And the more you have volatility, the more noise you're going to have because people are just going to pile up on that noise. And then a lot of investors are going to feel completely lost. And what I've seen a lot this year is concern around companies' earnings when they are being reported, and then a stock goes down by 10% or
Mm-hmm.
15% on one single day. And then people get very, very concerned about that, and fear is building up. But it happens all the time. And the reason why I say that is because at DSR, we cover over 1,000 companies every quarters. So maybe in your portfolio is the first time that you see that. And then, of course, it's quite concerning. I mean, your favorite company is down 15% on a single day. And that calls for selling right there, right? There's like, you don't want to be holding the bag for too long.
Mm-hmm.
But when you cover so many companies, we see that every quarter and not just in 25. I've been seeing that since the creation of DSR. So that is like since 2013. So it's been quite a while. So it's really business as usual. Now, it's important to understand why the stock dropped like this and to find the reasoning, the rationality behind it, because sometimes there is like very bad news and there's something going on there. So you need to investigate. And this is one of the things that we can do at Dividend Stocks Rock is we help investors understand what's going on with their portfolio and why the market sometimes reacts so violently to what sometimes may seem not as like super bad news, but just not a good
Mm-hmm.
quarter.
So, by the way, listeners, if you'd like to have us review your portfolio quarterly, hit dividendstocksrock.com. Listeners, let's empower you in the investment world with our free Dividend Rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. So, Mike, in the end, like what I've noticed over your answers to during the episode is that on the surface it looks good, but when you scratch a bit, it's not so good. So, in the end, do you think we're already in a recession, even if it's not like official?
I don't know. I mean, do my take on this matters anymore? I'm not too sure. uh, what I see though is a lot of indicators are relatively weak. I mean, they're not strong. So they're at
Mhm.
best stagnant, and thinking a lot of that could be just supported by that fear of like, oh, I don't know what's going to happen. So I'm just going to buy a little bit more right now. I wouldn't be surprised to hear that we are in a recession like in 1 or 2 quarters. Again, take it with a grain of salt, and I'm fully transparent. I mean, when I'm right, I'm happy to say it, but when I'm wrong, also happy to say it, just to show listeners and investors that regardless how many hours you spend at looking at the market, and that's what usually happens when people are right, they're just claiming like that on every rooftop, and they're screaming about that. I was right, I was right, I told you so. But
Mhm.
then when they're wrong, they all disappear. So I'm standing where I'm standing. I've been calling for a recession in Canada for the past 3 years. Didn't happen. Don't care that much, actually. And then this is what we're going to talk about portfolio management now. But that's the key is this when you look at all those indicators, it's more a matter of like not being surprised. Like if the
Mhm.
stock market would start to go down because investors would start really fear that we are going to enter into recession that is going to last maybe 2 years or something like that, it's going to be a little bit more panic around the market. I would not be surprised for that. So, and I'm fully prepared, mentally and financially prepared to enter into that kind of thing. So instead of like living in fear, I am looking at this as, oh, it's probably an opportunity that is going to develop, but I don't know when. And your crystal balls is definitely as good as mine, or maybe better. So
Mhm.
that's good for you. But I'd rather be always ready every single day, but not being afraid that it's going to happen.
Right. So now let's conclude with a brief framework of what investors should do to get prepared and feel as confident as you.
Yeah, there you go. So here's the thing. Right now, it is a very good time, regardless of what's going to happen later down the year, to revisit your portfolio because we are trading again near or at an all-time high. So it's a good time to make move. And it's kind of ironic. I had that discussion with my daughter because she's been investing for several years now, but she's preparing to withdraw a big chunk of that to buy a condo next year. And I
Mhm.
told her, well, it's a good thing that we do this now. And now you're going to move most of your money into a money market fund or something like high interest rate savings account. That will generate not much because you're going to spend that money. Well, you're going to invest that money into a condo in the next 12 months. But
Mhm.
it's a pretty good time to do it because we're at all time high. So when you sold, you pretty much like got the best of the out of the market. And then maybe it's going to continue to go up, but at least if you're prepared for your next step, it's a good timing to do it now.
Right.
So I have two frameworks today. The first one, if you are retired or about to
Mm.
retire, and the other one, if you're like me in the accumulation mode and growth mode, and you don't need to withdraw money from your portfolio. So if you are retired now, first you need to know how much you need in cash, and I'm not talking about sitting on the sideline and having dry powder. I'm talking about how much your portfolio generates per year versus how much you must withdraw from that portfolio. So, of course, you should have a plan by then. You should already know those answers, but then it's a good time to clean your portfolio, review your stock like one by one, just making sure are they all good? Are you like well balanced to trim a little bit more, cash your profit, and create that cash reserve that we've been talking on this show for several times because that cash reserve is your friend. If the market goes down after that, you don't have to care because by the time it's going to go back up, you will still be taking money from your cash reserve with a combination of like dividend payments, interest payments, and then the cash reserve. The second step is if you still have losers in your portfolio, as I said, 23 was amazing, 24 was amazing, 25 amazing year to date. If you still have companies that are struggling right now, do a deep dive because it's not normal. I mean, they're lagging the market like there's no tomorrow right now. So maybe they're just sick and they're going to die. I mean, sometimes you just have to make that cleanup. And after 3 years of like bull market and a lot of hope and a lot of optimism, if you have like a stock that is down like 50%, well, it's time to figure out in which world this company can come back and make a recovery
Mhm.
and what it's required to happen. And maybe by listing those requirements, you're going to realize that it's probably going to happen in another life and not in this one. It's a good time also to review your worst case scenario. So with your plan, making sure that you're not overexposed somewhere, which usually happens when the market goes up. And we have discussed that a few times and we have seen it. It's no like secret, but the S&P 500 has been driven by the Magnificent Seven in general
Right.
technology oriented stocks. If you have a lot of those in your portfolio, they're probably taking a large portion now because they have been doing so well, but they have been doing a lot better than everything else. So maybe you started 3, 4 years ago with exposure to technology sector or technology related, because keep in mind companies like Meta and Alphabet are actually not classified as tech stock anymore. So you want to be careful with that. But if you look at those, maybe you were at like 25% 3 years ago and you felt good about that. Maybe today you're at like 45. And if there's a crash there, well, you're overexposed. So you're going to take the hit a lot more than everybody else. So it's, again, a good timing to reshuffle the cards, making sure that you're well, like just do the classic rebalance here, well diversified. That's going to be
Mhm.
nice. And then finally, review your retirement plan And there's nothing better than a very rock solid retirement plan. So it includes if you go into a crash. So you don't have to worry about it anymore. It's already in your plan. You already know that your portfolio can take that hit and you're still going to continue to enjoy your life. So that is the most important part, I think, when you do those financial projections, is to cover those kind of risks. So after that, you don't have to look at the news anymore because you know that your plan is built thinking that that's going to happen. And if it's not going to happen this year, it's going to happen anyway. I mean, you're going to be
Right.
retired for the next 20 years. So for sure, 100% sure, you're going to go into a crisis. I'm sorry to tell you, that's going to happen. So you might as well include in your plan. Now, if you're in growth mode, first, don't get overhyped. The market will eventually correct. And some people just started investing maybe after COVID. So they've been living through this kind of dream market where everything goes up, everything is double digit. Even distribution rates sometimes are double digit, not to mention that. But everybody thinks that it's going to be the normal way of investing, which is not. So you have
Right.
to like calm down a little bit about that. Make sure that you know what you own and why you own it. And what I say by that is not just say, oh, it's going to be fine. I know that company, it's been around, or this fund manager is like amazing. A lot of people said that about Bell, for example, and that didn't stop them to cut their dividend and leave several shareholders with a loss of capital and a loss of income. So that is super important. It's important to have a clear strategy. No guesswork here. No, oh, I'm going to put another extra $10,000 in this company because I heard that on BNN. Yeah, well, it's not a time to make those guesses, to make those bets, especially in a all-time high market. This is how you get burnt because you become overconfident. So it's kind of like the other way around. When you're retired, you're just like, yeah, I want to put on the brakes. And where you're in growth mode and there's a bull market, you're just like, yeah, I'm invincible. Been there, done that, took a lot, my fair share of hits. So just want to say that you don't want to get overhyped and you don't want to think that everything that you touch is going to turn into gold. Not necessarily going to happen. Finally, if you're sitting on the sideline right now with dry powder because you expect that market crash and you want to be ready for it, you might be sitting on your hands for the next 3 years as well. I remember that was super interesting when I was a private banker back in 2014. Market was high, flying high, greatly overvalued. Everybody was concerned about this all-time high market and still thinking about the crisis of 2008. That was not too long ago. It was just like 6 years later. And the president of the segment I was working for, like the private banking branch, said, what if it's the beginning? And what if the market continues into a bull run that is going to last another 10 years? So have you thought of that? Because maybe we're going to have a crash, but maybe we're going to have an amazing market. And then he started to explain his vision. Well, he happened to be pretty much right. And that's why National Bank is so great. But that's another story. But I mean, I'm just making jokes here. But just to make it clear, maybe we're going to run this all-time high market for another 3, 4, 5 years, and then you're going to miss out on a big opportunity. So having a clear strategy instead and having that conviction in the way it works, and there are plenty of strategies that works. Just don't go looking back the one that generated the best return, but look at the one that will have the best fit for what you want to do moving forward. And therefore, you're just going to be happy. And that is why I haven't changed anything about mine. I've always been invested 100% in stocks since 2003. So I went through a lot of things over the past 22 years, but never changed that. And since 2010, most of my portfolio is invested in dividend growers because this is what I believe in. And that is more important than trying every quarter to benchmark myself against whatever works best right now and say I'm a failure because I failed to beat Bitcoin. Yeah, I failed to beat Bitcoin. That's all right. That's not what I want. If it's what you want, that's perfect too. That's the point. But then you're going to ride or die with your strategy, which makes a lot more sense than sitting on the sideline forever and trying to guess what's going to come up next.
Right. So, to help you review your stocks and make sure your portfolio can survive a recession, we invite you to download the free DSR stock checklist at thedividendguyblog.com/checklist. How can it help investors, Mike?
When it's time to invest, I like things that are simple and clear. And this checklist is like one page and it focuses on forcing you to answer yes or no to questions. So no more, there are great companies, they've been around forever. No, you have to look at the numbers and then you're forced to say yes or no. By going to binary answers like this, you force the rationality into your investment and you get rid of the fairy tales. So you cannot say, oh yeah, it's an amazing company. Okay, so what about the revenue? Oh no, they're not great. What about earnings? Oh, they're not great. What about the payout ratio? Oh, it's not great either. Well, then you have your answer. And that one pager is going to make it very quick for any stock that you want to analyze. And right now is the perfect timing to do it, because if you complete that checklist and all the answers or most of the answers are negatives, well, then you have a pretty good idea of what to do with your stock next.
Well, thank you so much, Mike, for all this information. Listeners, you cannot avoid recessions in your investment journey, but you can ensure your portfolio will survive. To help assess the health of your holdings, remember to download your free stock checklist at thedividendguyblog.com/checklist. For our show notes and related content, visit thedividendguyblog.com/241. Do not miss any upcoming episode. Hit pause and the subscribe button underneath our podcast logo now to get notified. Until next week, stay invested.
Stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.